Hey guys, Toby Mathis here, and today we have Caleb Guilliams, an expert in insurance, and we're going to be going over infinite banking. We're going to be going over what it is, what it's not, bank on yourself, all these different concepts, how it's being misused. We're going to dive into all of it. So I wanted to say first off, thank you, Caleb, for coming on and being willing to basically be subjected to a bunch of harsh questions.
I love it. We had you on our channel and you said a line, "Don't believe everything you see on TikTok." And I think that's going to be my favorite line in this show. A lot of people are saying a lot of things on the internet, and they're using insurance. And what we'll find is a lot of it's doing a lot of damage. So I'm here to ask your toxic questions, and very very much excited to dive in.
All right, well, let's dive right off the top. We had Kyle Busch and this huge case that just got settled out. There's been some misbehavior in this industry for a long time. What is it? How do we root it out? How are people being taken advantage by some of the life insurance agents that are out there?
Yeah, the first thing I would say is a lot of life insurance is being sold as an investment, and that is first a huge problem because the way that it's being sold is saying, "Hey, Toby, you want a tax-free wrapper to grow your money, tax-free income, blah 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 blah." They'll use words like banking and all, and they essentially say like, "Hey, the average people put their money in the markets and real estate and all those other things, but the real wealthy people put their money in these insurance products because it's a rich person's Roth kind of deal." And so in a lot of cases, they're over pitching insurance where it shouldn't be used. And then when it comes to the structuring and lack of disclosure, they're designing these products, which we'll dive into. There's a lot of different ways that you can design products, but they're designing it to very much fill their pockets, and the commissions on these things can be outrageous. And so with the Kyle Busch scenario, it was massively missold, but it was actually, there were so many things that the agent did that was just like, I couldn't even believe when I was reading the lawsuit. I was just like, you've got to be kidding me. Like there was lack of they just didn't even do the things that they were going to say that they're going to do. So they had they oversold, and then they had a product that they weren't even paying attention to. And you get this headline where Kyle lost over $8 million in an insurance product. It's given our industry a black eye, rightfully so, because of all the things that happened. So that's like if anyone's selling insurance as an investment, I think that's first and foremost, you should run from that personally.
Well, let's go over what infinite banking is, and then we can dive into the components and how it's misused. How about that?
Yeah. So if I had to describe infinite banking, especially if you're thinking about infinite banking with life insurance, what's essentially the pitch is you're making money. You can put it into a savings account, or you could put it into a life insurance policy. The policy should have some type of cash value component to it. And so we can talk about not all cash value components are created equal, not all structures are created equal. But the premise is you're putting money into a life insurance policy. It's growing over time. You get other benefits with insurance. And then instead of just withdrawing that money to invest in real estate, your business, going on vacation, paying off debt, essentially infinite. There's a bunch of things that you can do with your money. You're taking a loan against the life insurance policy. That's where the idea of being your own banker comes in. You're taking a loan against, you could say yourself, but it's actually the insurance company. And then what you're doing with that money is you're using it, and then your money is still in your life insurance policy. And so theoretically, the idea of putting your money into a life insurance policy, leveraging against it or borrowing against that there's nothing wrong. But it can be sold. It can very much be oversold from too much money going into it. And then a lot of people are thinking about, okay, well, if this is what I'm being told, then I can go buy my groceries, I can go on vacations, I can consume. And Toby, there's no free money. This is like you're putting money into something, and you're gonna have to pay that back, or you're gonna die. Like it's not free money. And so the abuses are how much money is going in, how the policy is structured, and then how you're using the capital. And if you use one of those things wrong, the strategy unfortunately can do more damage than good.
So let's say I'll break this down real quick. So we have a life insurance, which means, hey, if something happens to me, my beneficiary gets money. There's an extra payment, more than just the life insurance, the cash value that I'm putting money into, and it's going to grow tax free. as it grows and it's invested in something. We can go over that.
Yeah.
And then I might be able to even get the money early if I need activities of daily living, if I have a
Yep.
disability or something, long-term care, and it's going against that death benefit, the life insurance side. And then when I die, all those loans that I took out during my lifetime, which I didn't have to pay tax on, get paid back.
Correct.
So where do the wheels come off? Because that seems pretty straightforward to me. And I like infinite banking. I like the concept. I have policies, but I know that they're not all created equal. But so where do the wheels come off?
The wheels come off when the policy is not structured in a way that is actually advantageous to you. So the way that you mentioned life insurance is a contract, and contracts can be good or bad. You know this better than anybody. And so a contract can be designed to be in your favor, but in a lot of cases, it can be bad if the required premium puts you in a pinch because life doesn't work perfectly. It can be bad if the policy is not very flexible and doesn't give you early cash value to be able to use and doesn't give liquidity. And it can be bad if you're using that money to buy things that ultimately there's no repayment from either that asset or lifestyle. And so it's not a magic bullet. I think of it, if you do it properly, Toby, I think of life insurance as, over your lifetime, you're going to earn anywhere from 4 to maybe 6% of like IRR. So we're not talking home run investing.
Is
And
that,
then and
can
then
I stop you there real quick? Is that
yeah,
after the cost of insurance, or is that what you're thinking it's actually going to be, the growth
that's the internal rate of return is after all cost. And
after the
so
cost?
we primarily do whole life just from a conservative nature. And so we're looking at internal rate of return. The IRR is the actual rate of return, and they're including commissions. It's after everything, cost of insurance. And you're going to see anywhere from like 4 to 5.5% IRR. Now, that's I think that's pretty good, because I also know the other benefits of insurance. You get the living benefits, you get the permanent death benefit. You also get some tax advantages because that money's growing tax deferred, and there's mechanisms to use that money tax free throughout your life. And so overall, that's what we have, but it's not one of these like get rich quick like deals. And in a lot of cases, it takes a few years to have more money than what you've put in. And so the big problems that we can get into are people that are getting pushed into this. A lot of times it's the insurance is not the low hanging fruit that they should do in the first place. And then the second thing is there's no disclosures that are required to show people what you're making and how things are designed. And I just see over, because we get policies all the time from people, and people are being sold the world. They'll be giving books like the Infinite Banking book. I have a book. They'll use my book. They'll use our videos, but they'll structure policies that are average, and it results in hundreds of thousands of dollars of inefficiency over their lifetime, and it just gives people a bad taste in their mouth.
Let's say this. I will say that one of the things that I look at, and I look at policies, and I'm not an insurance salesman. I don't know the first thing about how to write the policy, but I do know basic things like, hey, if I give somebody $50,000 for a payment, and my cash value is $10,000 or my surrender value, that means they charge me $40,000 for
Yes.
something. And it seems like an awful lot to be charged. And is that real? And is
Yes.
it that simple to look at it and say, hey, that surrender value, if it's really low after that, your insurance salesman just took a huge piece out of you.
Yeah, the first year difference between what your cash value is and what you put in, it's a very healthy assumption to say the lion's share of that made up some type of the commission. Not always. There's always exceptions to the rule, but in most cases, if you're putting in $50,000 and your cash value is $10,000, it's a very healthy assumption to say that the business, the insurance company, paid $40,000 somewhere for that policy to get set up.
Ouch. That seems like a little bit extreme. And then do you look at that? Like when somebody comes to you and they say, here's a policy I'm looking at, or do you do second opinions on policies? Like if somebody's
Yes.
out there and they're looking at, like, say, hey, could you tell me whether this is good, bad, or whether there's red flags here?
Yeah, we do second opinions, and we also, if people have policies, we can do a free analysis and show them what they currently have, and in a lot of cases, over 80% of the time that we look at policies, it's an unfortunate conversation.
Yeah. So I used to use a really horrible example. I say, if you went into the butcher and said, "What should I have for dinner every night? Could you make me a menu?"
You're not going to be eating salad.
No,
Yeah.
there's no salad, there's no fish, there's no roughage. You're gonna be clogged, right? You're just gonna be having ribeye and fillets and maybe some lamb and some other stuff. Versus if I went into a nutritionist and I asked the nutritionist to design me a menu, it's gonna be something completely different. I say that's the difference between a fiduciary and a non-fiduciary, somebody who has to put your interest first. So when you're looking at it and somebody's bringing you a policy, what are the red flags that you're seeing in these policies? And what immediately can you save people on by just saying, hey, this, and this?
Yeah. So great question. First thing is, what outcome or what result are you looking for the insurance? The biggest, and I'm telling you, take this to the bank. The biggest issue with insurance, and we're going to continue to see this, is if it's heavily sold on retirement income. Number one, you can't call it retirement income. That's not even an official term that you should be using. But I'm telling you, these things can look amazing on paper, and they're using projections 30, 40, 50 years. We talked on the podcast, Toby, you're not a huge fan of leverage. These illustrations that use a bunch of income are utilizing leverage assumptions over 40 years, 50 years. And somehow that's not a problem, or it hasn't been snuffed out from the regulating arm just of insurance. So
what do you mean by
issue number one is
what do you mean by leveraged assumption, real quick?
Leverage assumption in illustrations, when people show you income from a policy coming out, or cash flow is the more technical way, there's some type of income assumption. Usually they're using either a wash loans, some type of loan feature.
Yeah.
And so I'll remain obnoxious, like I'll remain neutral here, but especially on products like variable universal life or index universal life, in those assumptions, they can assume conservative 6% earning, you're only paying 4% in some cases. And so over time, 50, 60 years of an assumption like that, it looks amazing. And then the question is, how likely is that actually going to happen? And it's not just like you might have less income. We've seen cases that it's like you think you're going to have $100,000 a year, and now you're going a reality that your policy will actually lapse and you'll have a tax bill if you don't put more money into it. And those are the kind of things that, life insurance gets a bad rap, and rightfully so. So going back to your original question, the first question is, why did you buy this life insurance? And even us, I would call us like life insurance ninjas, we're not going to be able to fix, crazy like outcomes from a standpoint. If you're sold a bill of goods, it is what it is. Insurance is a protection first asset that has other benefits, but it's not going to solve all your problems. So that's number one. Number two is, when we're actually looking at the policy, there's, to simplify this for the audience, there's what's called a required premium, and then there's additional premiums. When you think of like max funding, or some people call it overfunding, these are additional premiums that you can put in that usually have way less commission and give you lots of cash value. But one of my favorite things is they're flexible. And so what we see a lot of times, and this is more common in whole life than IUL, is these policies are sold, and I'll just use a $50,000 example, and sometimes the required premium is $50,000, which means that person, that agent, probably made $50,000 setting up that policy. That means you have almost zero cash value in the first couple of years, and you have very little flexibility. That happens. We see that all the time. Versus if you set up where maybe you have 20% going to the required premium and 80% being made up of, the PUAs or additional premium, like optional premium. Now, not only do you have a policy that has $40,000, let's just say, of cash value, the commission is, $10,000 versus $50,000, but now you have a lot more flexibility. There's a lot more things that we can do. So when we're talking to people, we're looking at, number one, what are their goals? Number two, what's like the mechanism of that policy? And then we're actually seeing if the policy is like performing, because it's just seeing how that is. And then we're able to project out and say, this is what this looks like. How does this integrate with other assets? If someone's just selling you insurance as the sole asset or the main asset, I got news for you. It's not going to be good. Life insurance should be integrated, whether it's with a fiduciary or whether it's with a team that can understand how a protection asset can blend in with other growth assets, how you make money. And if it's not integrated, then by default, I would say that you're probably not going to be best off. And I hate to be like the bearer of bad news, but if you avoid some of those things that I just mentioned, you are so much better off. And a lot of times the people that are abusing this are selling this as the one size fits all. And then to put the cherry on top, they're not structuring it very efficiently. And so if they structure it efficiently, there's at least a lot more options to exit or bring things down, but it's like the double whammy.
Well, let's go over a couple of things because you just threw a lot out there.
Yeah, sorry.
And I'm always thinking about liquidity.
Yes.
So I'm a real estate guy. I love investing, and I invest in everything. But I always think about real estate is, hey, I would love to be able to go buy a house. And usually, I'm not just sitting. People aren't just sitting around with a bunch of cash. I want to buy a house. And it would be nice if they had a policy that they overfunded for a period of time, and they had the ability to get a loan out of that policy. How much is that generally going to cost them? Like, are these lower rate loans, or do they take a piece out of you? And could they borrow that and then put it into real estate and make money off of that investment if their intent was to possibly pay it back? And then if they didn't pay it back, what's the ramification?
Yeah, great questions. Question number one: rates are anywhere from 4.5% to as high as 8%. 8%, if there is 8%, that's usually fixed, and so whether interest rates go up or down, you're fixed at 8%. And then the ones that are usually 4 or 5 or 6 are off of variable. So that's important to disclose. And a lot of our clients fund money into life insurance. The talking points is it could be a lot safer than your bank over time. Especially if you're working with solid companies, you don't have to worry about volatility of your money going up or down. You're obviously protecting you. There's a benefit of having a personal protection, but then you're utilizing that cash value, borrowing against that to invest in real estate. And there's one of 3 things that you could do. Thing number one is you could pay back that loan. It's unstructured, meaning you don't have to there's no one telling you have to pay interest or you have to pay it back during a certain time. So that's a good thing and a bad thing. So I think that a wise thing to do is if you're going to deploy capital, figure out a way to pay that back. And so my favorite is when clients have a payback strategy. Way number 2 is to just service the interest, to say, you know what, I'm going to pay the interest each year and just, have the outstanding debt. And then number 3 would just have that compounding loan happen. But obviously your money is hopefully in an asset that's appreciating. So what happens when you die? When you die, the insurance company is going to say, okay, Toby, you did an insurance policy with us. Let's say you have $100,000 of cash value and you have $1 million of death benefit, but you took out a $50,000 loan. What we're going to do is we're going to pay your beneficiaries $950,000. That other $50,000 is going to make us whole on the loan that you took from our general account. And so you mentioned you have a video on the buy, borrow, die strategy. Life insurance enhances you to do that, not just with an insurance policy, but with other assets, because it creates liquidity for you to have more optionality, and that money gets paid income tax free, not estate tax free, but income tax free. And so that's the 3 ways that you could borrow and the ways that you could pay it back. It will eventually get paid back. That's why the insurance company doesn't require you, because they're playing a long-term game and they know we have a liability called your death benefit, and you're either going to cancel your policy and then we're just going to give you the outstanding cash value. You're either going to die and we're going to pay your death benefit that we're already going to pay, just subtract the outstanding debt, or you're going to pay us back. And all 3 ways we're going to win. And that's why they can give you competitive loan rates and not require you to have to pay them back.
All right, let's play with this for a second, because I want people to understand this. Some people may have missed this. Let's say I had a $2 million death benefit. I have a $500,000 of cash value, and I have a $100,000 loan, and I pass away. How much are my beneficiaries going to get?
$1.5 million.
1.5. You have a $100,000 policy loan. You have $500,000.
Oh, sorry. So they're going to get 1.9 million.
1.9. You lose the cash value. Cash value is part of the death benefit, right?
Correct. And if you allow me to share that, because I think that is a talking point that some people talk about, and I would love to address that if you can give me a shot.
Yeah, absolutely. Do it right now. Let's
Yeah,
hear
so
it.
you're totally right. Where a talking point that people will say is permanent life insurance, you lose your cash value. And on maybe typical life insurance that I just mentioned, where all of it's going to base and all, maybe that's true, Toby, where it's like the death benefit stays stagnant. But anybody that's max funding or overfunding, your death benefit is going to grow a lot more than the money that you're putting in. And so while it is true, if you think about it from a tax perspective, it's actually very advantageous that the money is getting paid in a death benefit from a tax perspective. And in a lot of cases, that talking point goes out the window when you look at the increasing death benefit. But you're totally right. The cash value doesn't come to you in addition to the death benefit, but the death benefit should be at a place where it's far greater than your initial death benefit plus the cash value together. The death benefit in most cases will be far greater than that equation.
And the reason I bring that up is because there's all these things like the MECing, modified endowment contracts, and all these things. You literally, it's always going to force the death benefit up as that cash value grows. And especially for those of you guys, like there's some people that have IULs where you have a run, maybe you're able to get, I don't know what the term is, but let's say you're making 9 or 10% on a really good year, but that's before they take the cost of the insurance and things like that. I know, but let's just say that it's pushing it up and it's growing. You bought $1 million death benefit. Your cash value is growing, but so is your death benefit.
Correct.
But a lot of people think the insurance company just stole my cash value. And it's like, no, they paid it in a different way. That's why you need to pay attention to these things. Do you see people buying lower death benefit in the beginning, trying to put more cash value? And
yes.
You see agents trying to sell more death benefit under the kind of the pipe dream that, hey, we're going to have this huge amount of a pile of cash. We really need to have that $2.5 million policy. Do you see anybody doing that? And then
so
to do that?
Yeah, that's classic. You said it. There's really 3 ways that we could back into life insurance. Number 1 is income protection. And that's the question. It's a lot of term. And I'm a big fan of term insurance when set up properly. It's like, what's the least amount of money I can pay to temporarily protect, whether it's 20 years or 30 years time period. So that's number 1. And it's a commodity at this point. If I can get in a company that I can pay less, that has strong ratings, I'm going to choose them. I'm not going to just pay more because I like your logo. The second way to sell life insurance is estate planning. This is where the conversation of cash value is less important. It's more about, we want a permanent death benefit. I want to make sure if I'm 75, 85, 90, that I have a death benefit that gets part of my estate planning.
Explain
for me,
that. Like stop right there, because term works to a certain point, but you get to a certain age, it's not going to work anymore, right?
Yeah, very few term policies pay out, thank goodness. You don't want to cash in on your term policy. That means you died prematurely. But you get to a place where, let's say 30 years of term insurance for someone who's, 20, 25 is very reasonable. Let's say it's $700 a year. And then you get to that year 30 and it jumps up to like $30,000 a year. And then every year. So they make it almost unreasonable for you to stick with them. And so they know that, hey, we're going to insure a bunch of people and less than 1 or 2% of this is going to pay out because people are going to cancel. And it's a pure profit. That doesn't mean it's bad, but term insurance is very profitable for companies because they're taking in money and the numbers are on their side from a standpoint of paying out.
And they don't pay much to the agents that sell term too.
They normally in term insurance, they're paying 70 to 100% of the first year. So in that example, if I'm paying $700, I don't make math easy. Let's say I'm paying $1,000 of term. I'm going to make anywhere from $700 to $1,000 one time. There's no renewals. There's none of that. So that's usually standard when it comes to how commissions work on term insurance.
Now compare that to a whole life or an IUL.
And here's what's exciting is maybe your whole life is $10,000, and depending on how it's structured, it could be $10,000 or Toby, it could be as low as, we're writing policies with 10% basis, which means our clients are getting 85 to 90+% cash value, which do the math. The math is where our commissions are around 1,000, 1,200. So again, it doesn't make, and I don't want to be the person that says just because your commission's a little bit higher, meaning you're intentionally screwing someone. It's just, you have to understand, like, why are they writing it that way? And going back to what I was saying, there's term insurance. And then if you want to back in life insurance for estate planning, sometimes, believe it or not, the highest commissions come from estate planning, because estate planning, you want a permanent death benefit. And a lot of times you're locking it in. And usually it's in people that are 50s, 60s, 70s. Usually they're locking in a death benefit, and cash value doesn't matter as much. And so instead of overfunding, which would be actually very inefficient to hit the objective, which is a death benefit, you're paying mostly in base, but usually you're paying that from assets. And that tends to be the highest commission, but that doesn't make it a wrong thing. That makes it actually the most efficient from an estate planning standpoint. The problem is, if you're selling me a bill of goods that this is a cash value accumulation product, but then you're selling me what you sold me, now I was told one thing, but the reality is different. And then the third policy that I wanted to share is a high cash value policy. And in that case, we want the death benefit as small as possible, the permanent side, small as possible, and it's going to grow over time. Why? Because the difference between permanent death benefit and cash value is the net amount at risk, and usually that's lower commissions. Anytime I have permanent death coverage, and then that's permanent, not with like a term rider, my commissions are just going to be higher because of how do we back into that. And so that's usually the three type of policies. There's term, there's estate planning policy, and then there's high cash value policy. And I will just say, disclaimer, the problem that I have even with our firm is if we're selling someone a high cash value policy to do things like real estate or invest, we have to disclose to them, you're buying life insurance. You might be putting $50,000, $60,000, $100,000 of cash value in a year into life insurance, but don't think that this is going to cover your human life value. You might be putting in $100,000 of cash in a year, and your death benefit might be like $2 million, where you might should want maybe a $10 million. And so that's the dirty side of high cash value. Is it's great for your cash, but make sure that you're also having a conversation with your advisor or insurance agent and something about how much life insurance you should want, especially early on. And so that's my disclaimer.
You might have another term policy on the side.
Yes.
Right?
And I'm a huge fan. I myself have I have multiple permanent policies, and I have term policies, because personally, I'm not going to put the amount of money I need in permanent life insurance to cover what I want covering myself and my family.
Yeah, it might be cheaper elsewhere for what you're doing now, which when your
100%.
kids are young, you need to have more death benefit than when your kids are grown. That's
correct.
Probably the fact of the matter. So you may have a term policy and a high cash value policy to get you where you need to go, as opposed to what you oftentimes get sold by the sales guy who says, or salesperson who says, hey, we're going to get this really great policy and it's going to have this huge death benefit because, boy, we really need this death benefit because if something happened to you, your kids would need this, and they're doing it as a permanent, and now you're paying up the nose on that, and then you look at their surrender value at the first year, and you're like, my gosh, I've seen this $25,000, $50,000 a year. Better yet is the people that do premium financing where they're putting in $500,000, and they're taking a loan out to do it, and you're like, well, that agent just did pretty well.
It did really well. Yeah. The secret to life insurance is you want to get to premium finance if you want to make the big dollars. Because if you can go convince a client to fund $1 million life insurance with a loan, it looks great. I think time is not on their side though, in a lot of ways that these things are being written. But yeah, that's a very interesting space. I will say in most cases, having a term policy and a permanent policy, much better than having one trying to do both. Because normally you get an inefficient protection vehicle and an inefficient cash accumulation vehicle. And then one step further, if you're going to get term insurance, spend a few dollars extra and get a convertible term insurance. And what that means is, you remember when I said that at year 30, then it like jumps up? A convertible term insurance allows you anytime during your life, during that term, to convert to a permanent policy at the health rating you got when you got life insurance. So it's one of those things. I'll just use myself as an example. I got the best rating. Thank goodness. I'm knocking on my wooden desk. I got the
That's
best
healthy.
rating, and that means I'm healthy. And then, let's say over 10 years from now, I want to convert that into a permanent policy. Number one, I don't have to redo the health test. I just need to sign a piece of paper and convert a chunk of that into a permanent. So that's cool. But let's say something actually happened to me health wise that limits me from getting life insurance. I now have an option to convert that to more permanent coverage, and it just gives me optionality. So we're a big fan of convertible term, but convertible term is only as good as the companies that you're converting to. So not all convertible terms created equal, but I'm glad you mentioned the term product, because I think most people that are watching this and listening to this, you need to start with term insurance. Permanent life insurance is a luxury. We can talk about who should have it, who shouldn't, but it's something that it should be a want, not a need. Whereas I believe term insurance is still a want product because you don't need anything. But if it should be a necessity regardless of how much money you make. Is people should be getting they should be covering their money printing machine, which is their lives. And so that's just, a disclaimer.
We're funding their legacy too. I look at this and I say insurance, the reason you're carrying it is it needs to have a purpose. And so if I'm not mistaken, we have term. Hey, we're just buying insurance and something bad happens to me, something gets funded, which is great for a legacy plan if you're young and you don't have a ton of money, but you want to create something for your family that carries on beyond you. There's cash value, permanent cash value insurance, which is high death benefit, lower cash value. And then there is lower death benefit, higher cash value. It sounds to me like almost like that's a chord. Like people are trying to play one key on the keyboard, but sometimes it's better to play a chord. And you don't want to try to solve everything with one key, but sometimes you're looking at it
Correct.
going, all right, because I know that's my situation. You're not my agent, but I have multiple policies, and that's exactly. I remember sitting down and I used a CFP, so I was like, they were saying, well, we're going to accomplish this with this with this, and this with this. They didn't try to just jam it down my throat and say, this is the one thing you're going to do. You're going to eat steak every night, right? You're going to.
I love it. I think that is by default. I haven't looked at your situation, but that tells me that it's way more intentional than the average person getting an insurance policy. And so I think that's a great example.
Everybody should have that. I will say this. I wanted two things that I didn't hear you say that I want to raise. Number one is the asset protection component of that cash value. I've never seen anybody sue. I know that there's some states where perhaps you can, but I've never seen anybody sue and try to get the cash value out of an insurance policy. And I have tens of thousands of clients all over the country. I've just never seen it come up. Have you seen that come up? Is that something that's on your, something you guys talk about?
It's asset protection is a big part. Each state's a little bit different, but every state has some type of asset protection. There's actually a story, Enron, and this is Enron, the executives that committed fraud are still benefiting from life insurance and annuities because of the state of Texas.
So nobody, we used to call it the OJ. You had the homestead and the pension, and they couldn't touch. And I was like, yeah, OJ.
But I say, this is what I'll say. I don't necessarily love that, but I love that, and here's why. It's like, if it works for them, it's something that needs to be factored in. And those are the kind of things when we talk about death benefit, the living benefits. I'm not going to call it a long-term care deal, but it's very similar.
That was the second thing I wanted to bring up, and I want to hear what you have to say about that.
Yeah, so there's actual long-term care riders that you can get, but almost every permanent life insurance policy that we serve with our clients and most on the market have what's called chronic and critical illness riders. And what this essentially means is if you get to a place where you are either given a death sentence, you have so much time to live, or you're unable to do certain activities of daily living, you have the option to start spending your death benefit while you're alive. Now, without getting too super technical, this might be something you want to do. It might not be. But the point is, this is an option that you have that no one wants to think about themselves in that category. But if the statistics, it's becoming more and more popular as people are living longer. And so, yeah, so it's one of those things where as your death benefit's growing, think about that death benefit not just as something that gets going to pass on after you die, but it could be something that you utilize while you're alive. And these are all the things, the asset protection, the creditor protection, even some of the tax benefits are all things that aren't even factored into my original internal rate of return number that I gave you. And so when you factor those things in, that rate of return of life insurance goes up, and you think about all the other jobs it does for you.
So I'm glad you brought up the long-term care, because my family, my dad passed away from Alzheimer's. My mom has it. We're relying on long-term care policies that you cannot get anymore, that
Yep.
we had back in the day, that as long as you didn't let them lapse, they're not offered, because they're not winners for insurance companies.
Yeah. Insurance companies lost a lot of money
They
on
lost their
underwriting
shirt
long-term
side,
care.
because people keep living longer and their bodies are living, but their brains sometimes aren't keeping up. And so they end up with I think it's 2 of 7 activities of daily living,
Yep.
and they end up in a long-term care facility, or they need assistance in living. And you don't want to have to sit there and try to do that type of policy. It's part of a good insurance policy, a life insurance policy. So I'm glad you're talking about it, because I will tell everybody you need to have that, because there's nothing that drains an estate faster and than these long-term care costs. It's $8,000-9,000 a month to start at a regular facility that they're going to drain out of
Yep.
you're going to be paying it. It's better to have a policy that you can borrow against to cover that.
Yeah.
And
And
it does lower the death benefit too, right?
it does. And here's what's great is traditional policies, you can get them and they're very expensive. And so it almost is one of those, it's like you don't want to use it, but if you never use it, you're out, you could, in some cases, hundreds of thousands of dollars of what you're paying. So the beautiful thing about blending it with life insurance, it's like, if you decide to use it, great. But if you don't use it, it gets passed on to your heirs in a income tax free. And so that's why I'm glad that some of these things are being included with insurance. And think about it from the insurance company standpoint. They're already on the hook to pay this liability. We call the death benefit. And so if you're triggering some of these things, what does that usually mean? You're getting close to passing away. So for them, it's just one of those like, okay, we're going to be on the hook here. Why not give you that option? And so it's one of those things that's easy for the insurance company to do. That's why all the companies do it. And yet it doesn't really cost them that much in the long run, because they're already underwriting the risk.
I love the way you lay it out. Let's do this to finish up. What do you like when you sit down with somebody? How do you make sure that they're doing the right thing and that you're serving them in the appropriate way? What are the questions you're asking? And then let's counter that with, what are the red flags that somebody else might that maybe they're being targeted to be taken advantage of by an agent who's selling a product just because that's what he's trying to get commission possible.
So when I'm sitting down with somebody and at our firm, we're trying to figure out what is the outcome. And there's usually 4 common outcomes. There's an entrepreneur or an investor that they want a better place long-term than putting their money in cash and then investing. Or there's somebody who's wanting to optimize their retirement. I believe that permanent life insurance can act as like a bond alternative to your portfolio and give you lots of the benefits that we just mentioned, but kind of keep up with bond rates. And so that there's a lot of people that are just like, how do I shift some of my portfolio into insurance to give me maybe optionality in the future? There's a lot of retirement strategies that unlock with life insurance. The third type of person's coming to us and they're just like, you know what? And a lot of times it's coming with an estate planning person. And they're just like, we want a life insurance for an estate plan. And so we're just structuring a policy that's most efficient for them. Or the fourth one is income protector. 90% of people that come to us, I shouldn't say to come to us, but 90% of people, like generally, they should just be protecting their income. There's no conversation around bond alternative or high cash value life insurance or legacy planning. So the advice of buy term and invest a difference is actually good advice for 90% of people out there. And then it comes down to, okay, if you see the benefits of life insurance, like myself, I put a lot of money into a high cash value life insurance, and then I use that capital as an emergency fund, as a reserve to invest, and as just as an opportunity fund, and I'm able to deploy that. That's what I choose to do, but I'm not everyone thinks the way that I think. And then I do believe that there's going to be more conversations about this being a bond alternative because of all the options when it comes to distribution planning. A lot of retirement planning is focused on accumulation, but we're not really talking about distribution. And there's a lot of things, whether it's annuities or whether it's volatility buffers, or whether it's even things like, I'm going to say a horrible 2 words, reverse mortgages, which can get a bad rap, but they can be used properly. And a lot of times they all get better. Annuities, volatility buffers, reverse mortgages, other buy, borrow, die strategies that open up usually all get better if you have a solid life insurance policy. It just gives you another option to consider something. And so that there's a lot of academic research right now, Toby, that's talking about distribution, and they're using actuarial science, which is a fancy way of saying insurance companies, to help you create more certainty and more income. So that's a big conversation we're having with financial advisors, fiduciaries, people that coming to us because they know that's where our specialty is. And then obviously the 1% of people that have an estate problem or really want that next generation to be funded, they're coming to us and trying to back in how life insurance can be used. So those are like the 4 different ways that people are coming to us. And a lot of times there's a combination of you care about your legacy, you care about, and so we're trying to figure out what are we optimizing for first, because what you said, sometimes you can't do it all well. What are we trying to optimize? And sometimes that includes 1 or 2 policies to do 2 or 3 things well versus trying to accomplish it all in one policy.
And then what are the red flags? I mean, there's Rockefeller people out there saying everybody should have an insurance policy, max fund, blah, 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 blah. There's people saying this is, the bank on yourself and the infinite banking, put all your money into this huge policy and live off it when you retire.
Yeah,
what are
don't
the
do
big
that.
red flags that people are waving that you're like, hey, stop.
Yeah, I would say I'm going to say something that's probably going to get me in trouble. Life insurance shouldn't be more than 20% of your retirement income portion. If it's more than that, I'm telling you that would be a red flag to me. I personally am not looking to use my life insurance policy to create income. I'm using it as an asset that gives me options, but it's not one of those things that I'm looking out 30, 40 years and going to see that stream of income. The other red flag is people putting too much money into it. And always ask this when you're talking to an insurance agent or a financial advisor, is whatever your premium going in, figure out how much of it's required, what's my minimum premium, and then how long do I have to fund to? Is it 10 years, 7 years? Is there an exit? Just understand those things. And then my whole thing is the cash value. Know this, that it's possible to have 85 to 90% first year cash value. If you're being told that this is the optimal design and you have 40% of cash value in year 1, doesn't make the agent bad. They could even be right. But I'm just letting you know that I would at least get a second opinion. And that's the other thing, is having a second opinion. And you're a big fan of having a fiduciary in your corner. I think that's really, really smart. The problem though with fiduciaries, a lot of them don't understand insurance. Mm-hmm. And so it's important to, having a second opinion is a no-brainer. You should always have people that are challenging what you're doing. And so you should do that, but just make sure that the second opinion is someone that actually understands what you're trying to accomplish and understands insurance. The problem is there's a lot of people that hate on certain things. And so no matter what you show them, they're going to be like, this is a scam. And I don't love the word scam, but I do think that because of Kyle Busch and so many others, and we're going to see a lot more lawsuits. Pac Life just did a class action settlement over $50 million, and that's one of many to come. And so people have been abusing insurance, and unfortunately, it's given our industry a black eye, and I feel like we're only getting started.
The commissions were too big. It was too tempting. And to somebody who, again, I'm talking to somebody and I'm looking at a $50,000 payday for me on something, that seems like it would be a motivator for someone to perhaps oversell something, because again,
and on an illustration,
that's what they're going to do.
Well, and there's been technically the Kyle Busch person was a fiduciary. That's why it's like not all. It's funny. It's you put 100 fiduciaries in a room, you're going to get 101 ideas, but yeah. The cool thing is they have extra, they can go after that person in a higher way because of the quote unquote fiduciary. And so, yeah, I'll say that I'm sorry, I forgot what else I was going to say, but I'm with you.
I want to just clarify something, because I say fiduciary, you want someone who's going to put your interest before their own.
Yes.
And
yes.
The way you know that, and you just hit something that I neglected. Even a fiduciary, you still want to run the math. in tax, we always say calculate, calculate, calculate. And anything you do, you should run the calculations. You should have somebody who understands what those numbers mean, obviously, but you should have a second opinion on whatever it is you're looking at and not feel like you've done anything skullduggery. It's, okay, could you take a look at this and see if the numbers make sense? I've done that with many clients where I brought in an outside party that was not even it was just an insurance expert that from courtrooms. And I was like, hey, where are the problems in this policy? And they blow
Yep.
them up pretty quick because they're like, here, here, and here. And you're like, hey, what about this, this, and this? And then the client gets kind of mad because the person wasn't telling them. Usually the numbers will tell you the story. So get somebody that knows it. By the way, you're somebody that seems to know it. I'll put your information in
Okay.
the show notes so somebody can say, hey, Caleb, what do you look at? Are you willing to do that first off?
Yeah, we're 100% willing to review any policies. And if you want a second opinion, even if you want to work with your person, make us be the bad person. Make us be like, we've done this for people. We're like, hey, this, and this. And then they'd say, hey, can you design this? You'll be amazed. You'll be amazed what's possible if you just get a second opinion. And no, I agree with everything that you said. And I am a big, big fan of permanent life insurance. But yet I joke, I think a lot of people in our space don't love me and I've had people literally say, I hope my clients never see your channel. And I'm like, okay, I can't believe you said that out loud, but it's just the truth. We're trying our best because unfortunately there's a lot of bad things in our industry, but life insurance when set up and used properly isn't a phenomenal asset. And so it's just because credit cards hurt a lot of people, just because a lot of people lose money in starting businesses doesn't make starting a business or using a credit card inherently bad. It just means that we got to disclose. And I also think it's important to show people different options and educate them. And more information, especially when it comes to your money, should be something that you should require. And so, Toby, it's been an absolute pleasure being on.
Yeah, well, I appreciate being on. I'll put your channel link and I'll put a link so that people can get a hold of you. And as always, guys, you can put comments down below, like and subscribe. Share this with anybody that you think would benefit. Caleb, I invite you to come and look at some of the comments. Maybe people will ask you a few questions down there in the comments.
I'll be in the comment section and look at all the comments. And Toby, I'm a big fan of your content and what you've created, and it's an absolute honor to be on here. And so thank you so much for what you're doing and bringing me on.
Well, thanks for coming on and sharing.